When I was making my first move from a PG to an apartment in Bangalore, I seriously considered getting a credit card. I was going to be paying quite a lot of money right out of pocket. My final rent to the PG, my first month's rent at my new place, and the dreaded security deposit. After all these were paid off, I realized I had a whole month to go and not a lot of money to spend for daily expenses. Plus, I also had to furnish my new room. That's when the thought of getting a credit card seemed really attractive. I could get one, use it for my expenses this month, pay off the bill when my salary arrived, and never use it again. But once I had spoken to a few friends and colleagues and heard some horror stories about credit card debt, I decided there was no way in which I could afford that. So I turned to my family instead. Now, it didn't feel great to borrow from my parents as a grown up who was earning, but it was also the wiser choice to make at the time. And I'm still grateful for their support because I didn't have to risk going into debt. But there are many young people fresh into their careers moving to new cities who need to make similar decisions. And not everyone has a family that can support them. So, for them, debt is the quickest and only choice. And turns out, more and more of those debts are now being taken on by fintech platforms, not banks. RBI's latest report on financial stability showed that nearly 57% of India's small ticket, which is under 50,000 rupees, personal loan market is held by fintech lenders. And doubling down on this increasing market share are predatory NBFCs, who have ended up charging their customers upwards of 600% interest. We'll be getting to that story soon. But before that, here are some more numbers you should know. Because at the same time, public sector banks or PSBs are seeing their share of household deposits fall from more than 70% to about 63% over the last several years. And this deterioration is only accelerating. In just FY25, PSBs got only about 50% of all new household deposits, a loss of about 7% in a single year, which means less and less people are starting deposits with PSBs. That's probably why last week, Nirmala Sitharaman, India's finance minister, asked public sector banks to get cool and see how they could become more attractive to young people. Her suggestions include things like yoga vouchers, credit scheme awareness campaigns, and youth centric in bank experiences. But the thing is, Gen Z is not avoiding PSBs because they are uncool. It's because these banks don't provide a service that is increasingly becoming a necessity for the generation in the way that they need. Global studies show that 55% of Gen Z are delaying lifetime milestones like marriage or higher education because of financial strain. And earlier this month, my co host Snigdha had spoken about the effect rising retirement costs are having on young professionals. And yet, Indian Gen Z are borrowing credit for consumption like never before and risking getting caught in vicious debt cycles. Welcome to Daybreak, a business podcast from The Ken. I'm your host, Rachel Varghese, and every day of the week, my co-host Snigdha Sharma and I will bring you one news story that is worth understanding and worth your time. Today is Wednesday, the 26th of August. The pattern we see is no longer about need, it's about identity. This generation is not borrowing because they can't afford things. They're borrowing because they don't want to feel left behind. That's what Saurabh Bansal, the founder of a SEBI-registered wealth advisory called Fin at Work, said in an interview to Outlook magazine. Bansal and other experts believe that social media, influencer culture, and an overflow of consumption choices is now making credit a lifestyle funding mechanism. It's no longer something that people lean on only for emergencies or major life commitments. And the data is showing that shifting trend as well, especially in this recent study called How India Borrows from a consumer finance firm called Home Credit. It showed that personal loans taken to specifically enable premium consumer electronics and high-tech gadget purchases grew by 36% in just 4 years since 2020. Another study showed that nearly a quarter of personal loan borrowers used it to fund holidays. Meanwhile, the loans taken for medical emergencies decreased by 4% over 4 years. Basically, this was not a priority for modern borrowers. And a large number of these borrowers are Gen Z, and many of them are borrowing for the first time. A TransUnion CIBIL report from last year showed that Gen Z are coming into the formal credit system quite quickly, making up 41% of all new to credit or NTC borrowers in India. And even in that segment, over a quarter of them chose consumption led products like credit cards as their entry points. The reason for this change in borrowing behavior lies in an overall insecurity in the current economic conditions. Cost of living keeps going up, rents in metro cities like Bangalore and Mumbai are always a topic of concern, and AI is increasing job uncertainty. A global survey from Deloitte showed that financial anxiety is a source of daily stress for 44% of Gen Z and millennials. And for more than a quarter of Gen Z specifically, cost of living is their main concern. It even comes ahead of unemployment. So, in the midst of all this insecurity and anxiety, why risk debt? In the US, the phenomenon has a name: doom spending. A CNBC report described it as a way for people to self soothe while feeling pessimistic about the economy or their future. You see, saving for a house starts to make less sense when property prices keep going up and the same grocery bill starts to look more expensive as time goes on, even though the items themselves haven't changed. So, spending or borrowing to spend becomes a way to address present needs instead of future ones, especially ones that seem out of reach anyway. For Indians, though, this phenomenon is slightly more complicated because they haven't quite given up on saving yet. In fact, another report from Boston Consulting Group showed that a majority of Indian Gen Z saved regularly, and 35% of them had started investing before the age of 25. In a way, both answer the same anxiety. Saving, especially with longer investment horizons, does offer some kind of safety net in the future. At the same time, borrowing enables the short term aspirations of getting the latest iPhone or going on a first solo trip or making the move to a nicer apartment. These needs are inherently more urgent. It's not always possible to wait for a bank to clear the kind of unsecured loans that a trip or a concert ticket would specifically require. Plus, as first time borrowers, many would also not be likely to have credit scores, which is what banks largely evaluate for approvals. And that's why younger borrowers are opting for non banking financial companies or NBFCs instead. More on this in the next segment. NBFCs don't care as much about credit scores or loan histories. And most times, the amount you borrow will land in your digital wallet in a matter of minutes. But that speed comes at a cost. A couple weeks ago, my colleague Mudassam Khan and I had sat down to discuss the kind of predatory practices several RBI approved NBFCs take part in. Often, they charge interest of 365% to 500%. They do so by charging 1% interest on the daily, with tenures being anywhere from 10 days to 6 months long. 1% a day obviously adds up to 10% interest over just 10 days. And of course, for a year, that number becomes 365%. One of Mutassim's sources for this story was a man who had gotten caught up in a bad loan cycle who had been facing an interest rate of 600% for a short tenure loan of just 75,000 rupees. He was 34 years old, earning about a lakh a month, and still he could not pay off that loan. And so the lender offered him a way out by suggesting a top up loan through a different app. But because the borrower hadn't proved creditworthy for the new sum, he could pay off only a part of his original debt. The remaining amount began to compound at a penalty rate of 2% every day. And when that amount became due, there was another new app, another top up. And by the end, he was repaying around 6 lakh rupees a month and owed money across 8 different apps. That's just one story. and of a millennial with a decent salary. Imagine how much worse a cycle like that would be for someone who's quite new in their career and even less established. A 2023 BBC documentary called The Trap claimed that up to 60 Indians, most of them young, had committed suicide after being harassed by loan recovery agents. Some would turn up at the doors and workplaces of these borrowers, and in one case, a young woman's contacts had received morphed pictures of her as a recovery tactic. These cases were largely linked to loan apps with Chinese roots, but Mutasim's research indicates that the recovery methods of NBFCs even today can be almost as harmful. And increasingly, more young borrowers are joining India's formal system. In fact, a 2026 report from CRIF Highmark, one of India's top credit bureaus, showed that the number of NTC borrowers grew by almost a crore from 2022 to 2026, from 3.6 crore to 4.4 crore. And out of those accounts, 2.6 crore were supported by NBFCs and fintech platforms. What makes them so easy to use is that most of these apps use automated processes that usually ensure that the money borrowed is deposited in the borrower's account in about 5 to 10 minutes. They basically look out for red flags in the borrower's financial activity by looking at income deposits, bill payments, and frequent UPI usage. If the borrower gets a regular paycheck, uses UPI, and pays off bills regularly, they are likely to be approved. A human is only involved if something looks unusual. Banks, on the other hand, still maintain a human in the loop process for financing lending, which significantly increases the timeline. Reportedly, the process for a small ticket loan from SBI takes up to 10 days, with the approval process taking about 2 to 7 days and the disbursal of the amount itself taking another 3 days. But stories like the one you just heard show that this is an unsustainable trend. Obviously, it's clear why Gen Z prefer NBFCs. But stories like the one you just heard show that it is an unsustainable trend. Because getting caught up in these cycles mean that the generation that clearly cares just as much about saving as it does spending could essentially lose out on both. If Mutasim's source was earning a lakh a month and was stuck paying off 6 lakhs every month, what opportunity to save or spend could he possibly have? And if this is a troubling cycle that's emerging from young people's borrowing habits, it makes sense to introduce them to safer options. Banks usually charge interest rates of about 9 to 10.5%, have longer tenures, and less aggressive recovery practices. But does becoming cool just mean becoming more accessible? What does a cool bank even look like? At least based on what Sitaraman suggests. Maybe when a young person walks into a bank and heads to a Yuva kiosk, which is one of Sitaraman's suggestions, by the way, the person sitting at the kiosk is also Gen Z. And maybe, unlike the usual formality of bank dress codes, this person is dressed more informally, in cargo pants or something, or they have the trendiest haircut. And next to them on the desk, there's a stack of vouchers for yoga classes or free online courses. And the decor might also be more youthful. Instead of uncomfortable metal or plastic chairs, maybe there are more colorful sofas and beanbags instead. But would all of this really even attract Gen Z? Some academic studies say that it's unlikely. A friendlier surface is just that, because under this facade of young account managers and gym vouchers, the system still doesn't really offer the speed and convenience most young people want. Even a banking official in a business standard report explained that the loss of incremental deposits is less about users losing trust in PSBs and more about customers seeking convenience, competitive rates, and product variety. See, young people want to borrow. And considering the bad loan cycles like the ones we just heard, it stands to reason that they would like to borrow with better interest rates and safer recovery mechanisms. At the same time, they also like to save. A 2024 study by Aditya Birla Sun Life Insurance found that 76% of Gen Z Indians prefer stable investments like FDs, 70% focus on 5 or more years of investment horizons, and 73% said that debt and unexpected losses were their biggest financial concern. That doesn't sound like a generation that's doom spending just for the fun of it, does it? Which means Sitaraman's pitch has part of the right idea. Gen Z is in fact a demographic that banks could benefit from tapping into, considering so many of their desires match so well with exactly what they offer, except for the speed and convenience. But turns out the structural tools to address those concerns do exist. One is the account aggregator framework. It's basically an RBI regulated platform that allows users to securely store and share their financial data between different financial institutions, but only with their explicit consent. It means that one does not have to upload documents for every application, and plus, even if they don't have a history of credit, banks can use their other financial data the same way NBFCs do. They look at whether incomes land regularly, if bills are paid off on time, and if someone even uses e commerce often. Obviously, that's quite a useful and speedy tool for banks to have. In fact, RBI was pushing the use of this framework quite a bit at the end of 2025 because, as Rajneesh Karnatak, MD and CEO of Bank of India, said, only 16% of NTC loans were extended by banks, and the rest were facilitated by shadow lenders. The second tool is co-lending with NBFCs. Business Standard reported that in 2020, RBI was introducing this move to improve the flow of credit to the unserved and underserved sector of the economy. It also wanted to make funds available to beneficiaries at an affordable cost, especially considering the lower cost of funds from the banks and greater reach of the NBFCs. The plan of the co-lending model was also to keep the NBFCs as a single point of interaction for the customers, which would help banks and NBFCs to split the risk. Neither has really worked well yet, especially for the demographic in question. For the account aggregator framework, awareness is still low. An industry estimate said that only 38% of Indian account holders have AA enabled. Co-lending, on the other hand, was only recently opened up last year to cover all lending activities instead of just priority sector lending. So, even this method is yet to pick up steam. From October 2nd this year, India's PSBs are set to launch a month-long campaign including outreach to colleges, universities, and skill institutions. Sitaraman said in her speech that public sector banks must be the first and most trusted choice of young Indians, with the banks becoming part of customers' journey from their first account and salary to higher education, entrepreneurship, and their first investment. To be a part of all of this, lending is emerging as one of the most necessary tools to engage Gen Z. And PSBs already have the pricing advantage. But if they can actually make use of tools like account aggregator and co-lending to match the speed and convenience of NBFCs, the same borrowing decisions Gen Z are making today for a new phone or a trip could eventually carry significantly less financial harm.
Daybreak is produced from the newsroom of The Ken, India's first subscriber-focused business news platform. What you're listening to is just a small sample of our subscriber-only offerings. A full subscription offers daily long-form feature stories, newsletters, and a whole bunch of premium podcasts. To subscribe, head to theken.com and click on the red subscribe button on the top of the Ken website. Today's episode was hosted and produced by my colleague Rachel Varghese and edited by Rajiv Sien.